Time to get focused with Focus on Investing.
What's good, YouTube? We're here again for another Sunday, or for me, evening session. It's 8 p.m. on the 22nd of May, 2022, UK time. It's 3 p.m. Eastern Standard Time, I think, and 12 p.m. Pacific time. If I can be heard, can I get a 1 in the chat, please? Yeah, coming to you live and direct on the YouTubes. If you can hear me, give me a 1 in the chat so we know we're cooking for this week's session. Here again with Focus on Investing for another weekly dose of your investment knowledge. You know, this is where we give you the real talk when it comes to, financial investing and financial investment knowledge. Here, there's a lot of people, out here giving you financial advice, or, let me not say financial advice, because, a lot of people give disclaimers and things. So there's a lot of people, teaching you investment and trading strategies. However, a lot of them are misleading or misguiding, right? So, here at Focus on Investing, this is where we drill down to the nitty gritty and we get that proper information, and we separate ourselves from the make-believe, the real from the fake. When I send a shout out to Stun Legacy in the building. Salute to you, bro. Salute to Jeremiah L in the building as well. Good to hear that I can be heard for this, heard this week. I should say, good to hear that I can be heard on the YouTubes. And looking forward to this week's session. We're looking to deep dive again into these trading strategies, and we've got to put ourselves on a different level, on a different tier when it comes to this trading and this investment thing, right? Before we get started, we've got to do the usual housekeeping. If you haven't done so already, please hit the like button. Please hit the like button when you come into the building. Hit the like button. If you haven't done so already, please hit the subscribe button. And, if you can, share the stream. All right. Also, if you would like to support the stream, you can also do so by hitting the Cash App. Let me bring the Cash App up on screen. Let me share my screen so you can see the background. Let me bring up this window. There you go. The Cash App is on the screen if you would like to support the stream. The Cash App is £, and then Focus on Investing. That's £, Focus on Investing. All right. Well, let's get into this week's session. Let's get the proceedings proceeding this evening. Here we are again with another week. Another week, we're gonna get into some, trading knowledge, get our trading game up, our trading IQ up a level this week. We're gonna do a little session, and then that's probably gonna be for the first hour, and then probably for the second hour, any kind of questions or any kind of thing you want to address, or any kind of comments, questions, concerns, any stocks you want to look at, any Forex you want to look at, any commodities you want to look at, any questions you got, then you can put that in the chat as well. We can go into that. We can go into some analysis, any kind of deep dive you want to do. This is what we're here for. We're here every week to improve your trading knowledge, improve your investment knowledge, and we're looking to make a difference. So got a message from Mo. He said, looking forward to the one-on-one consult. I hate you for scheduling this week. No problem. If you're part of the Focus on Investing group, you can schedule a one-on-one with me with the link on the platform, and then we could do a deep dive into your whatever your situation is, and kind of look to improving your financial future in terms of strategies and however you want to go about your setup for setting up your financial investments. So we can definitely take a look at that. Or just give me a shout in the Focus on Investing platform, and we can arrange that. Again, anybody that's interested in raising their financial knowledge and getting involved into our financial syllabus. We have our investment syllabus with all of our investment mindset tools. Also, giving you all of the stocks to invest in, giving you trending stock lists every week. You can do so and find that at focusoninvesting.io. All right. So let me ask the chat. What do you want to do first? We're gonna the scheduled topic for this week is actually, let me go through the scheduled topic first, and then we take questions afterwards. All right. So so we're gonna move forward. This week's session, we're gonna really talk mostly about how do you get high stock market returns, or not even necessarily stock market returns. How do you get high returns on your investments? And it's not just about getting high returns, right? It's about getting consistent returns. Okay. Just for a show of hands in the chat, how many people in here are already involved into some sort of investment? Let me get a 1 in the chat if you've already involved into some form of investing. If you've already engaged into some form of investing, can I get a 1 in the chat? And that can be anything, whether it's in terms of stocks, it could be in terms of crypto, it could be in terms of Forex, it can be in terms of commodities, it could be maybe something outside of that, it could be something maybe in terms of property. Okay, I see we're getting 1s in the chart. See, Jeremiah L says he's giving a 1. Mo's giving us a 1. Studying legacy. I'll say Keystone 291. Thank you for joining us in the chat. Okay, that's good. All right, let me ask the second question then. How many of you have like consistent profits? When I say consistent profits, I mean profits that come in on a regular basis, or is it more sporadic? If it's consistent, let me get a 1. If your profits are a bit more sporadic, let me get a 2 in the chat. So that's if you have consistent profits. Let's have a 1 in the chat. If you find your profits are a bit more sporadic and you don't have like a consistent, let's get a 2. So we've got a 2 in the chat from Mo. Okay. Jeremiah 2. Okay. Anybody else? 1, 2. So the general consensus seems to be okay. Keystone as well. Stun Legacy saying a 2. Yeah, I mean, this is the the issue that a lot of people have when it comes to any sort of investment, right? Because the idea of investment or investing your funds is, again, everybody wants to have investments. So ideally, you would create an additional stream of income, right? The goal or the aim, I think they say, in order to get financial freedom, you need 7 different streams of income, right? And they say 7 generally because, as one is successful, the other one, can go down. And as anything, you have ebbs and flows and waves of different, types of investment. So, they typically say that you need about 7 different streams of income. And the reason why you need those 7 is, it is literally, that difficult to get, consistent profits. And you want to get consistent profits because you want it to ultimately replace your income. Because when we're talking about wealth, wealth is not measured in money. Wealth is measured in time, right? Because this is why they say the term intergenerational wealth, right? Intergeneration is a measure of time, right? It's not a measure of amount, right? You don't say how much money do you have in your account. You don't say how much money do I have in my account. I have intergeneration, right? You say, how long or intergenerationally, right? So when you're talking about intergenerational wealth, you're talking about wealth that exceeds, past your lifetime, right? You're talking about wealth that is either come from your, father or great grandfather or great great grandfather, and wealth that is going to exist to your children, your great grandchildren, your great great grandchildren, and etc. Right? So when you're talking about wealth, you're talking about wealth is a measure of time, right? Most people, they end up living hand to mouth, right? So as their check comes in at the end of the month, by the time, most of the time, by the end of that first day, the majority of that money is gone. They've spent it on bills. They've got their little turn up. A lot of people, they get paid on a Friday night. Friday night, they're up in the club, tricking off the money, spending it off, splashing it, turn up for the weekend, just to kind of get some kind of enjoyment out of their life because they've been working so hard for all of those months, for the whole month, all those days of the month. They've been working hard and they've been dying to get to the end of the month just so they can get that paycheck. When they get that paycheck, most of it gets splashed off, that first night. If not that first night, that weekend, they've been waiting to get the money so they can finally pay, such and such bill, or they can finally pay off for, maybe, something money they've been putting away for something, whatever it is, they spend it off, as soon as they get it most of the time. And then you got to look at, the rest of the month. They're paying off. By the time it comes to like the final week of the month, most people are struggling. Most people struggle by the time they get to the final the final week of the month. And this is what we talk about, wealth being a measure of time, because if you're living hand to mouth, the time in which you can survive in your current financial state is essentially a month, right? People are living month paycheck to month paycheck, right? If you've got a little bit of money, maybe if you don't get paid for that month, you might be, cool for the next couple of months. This is what they talk about. Wealth is like, how long can you go without seeing another paycheck? If for some reason, that I don't wish this on anybody, but for some reason, imagine you lost your job. If you lost your job, right, how long can you survive, without getting another paycheck? This is what we talk about wealth. Some people, if they've put away some kind of savings or something along those lines, maybe a couple of months, maybe 6 months, if you're lucky, maybe a year, who's to say that, you might not get some kind of ill health. If you get ill health, how long can you survive without that, right? And people's got their savings, but eventually, your savings will deplete. Savings are not infinite and not all time lasting, right? So the idea is that, instead of burning up savings, you want the ability to earn money while you're not working. Well, how do you do that? Well, you do that by disconnecting your personal day-to-day effort or your personal time from your earning of money, right? If the measure of wealth is measured by time, then, and you only have 24 hours in a day, then if your money is tied to your time, then you are limiting the amount of money or the amount of wealth that you can generate, right? Because if you only have 24 hours in a day, then 24 hours is a limited amount of time. So if you have, if you tie your money to your time, then again your money is limited. So therefore your ability to generate wealth is limited as well, because it's based on time. And also, again, if you become sick, then your time doesn't become your own, because you're not in control of your time. So also you're limiting your wealth. So you've got to get yourself into a position where you disconnect your time from your money, right? And how do you do that? So you do that by well, there's two different ways to do that, right? There's a thing they call leveraged income and a thing called passive income, right? Leveraged income is income that like amplifies your money or your time, right? So an example of leverage income would be maybe you do something once, but you can leverage the value of it maybe 2 to 3 times. So let's say, for instance, let me think of an example of leverage income. Leverage income would be, let's give an example of something that you could imagine. You could create something once but sell it twice, something along those lines, right? This is not a great, I'd have to think of a better example. But leverage income is where you can do something and then you can, amplify the profits of your return. So a good example of that would be compounding and trading. If you're part of the Focus on Investing community, you can learn how to compound your winning. So essentially, a compounding of your winning is, if also that's a good example of leveraging, right? So in trading, right, when we do trading, we do spread betting. So spread betting essentially says that, you're going to, it's essentially a bet. It's a bet on the movement of any type of stock with the broker, right? So let's say, for instance, we're going to use this example because we've got it on the screen, AMC, right? So AMC, let's just say AMC is trading at $12, right? And let's say, for instance, let's go and say $12.03, right? This is what we're trading at, right? We could bet our broker via spread betting. We could bet the broker that every time it moves up 1 cent, we're going to bet $1, right? So in the up direction, we're going to say it's going to go up, it's going to go bullish, and we're going to buy AMC, at 1 cent, right? So for every cent that it goes up, we're going to bet the broker that we will receive $1. And equally, in that situation, every cent it goes down, we will owe the broker $1, right? So we're currently at $12.03. If the price of AMC goes from $12 to 3 cents, from $12.03 to $12.04, AMC itself has gone up by 1 cent, right? So AMC has made a movement to the upside of 1 cent. But because we're in a leveraged financial situation, you know, because we bet our broker $1 for every movement of AMC, AMC has gone up 1 cent, but we would have made $1, right? So for every cent that AMC made, we have moved $1. So we have leveraged our income or our profits by having a setup in that fashion, right? So in this context, we would have increased our money by 100 times. It would be 100 times leverage or 100 times increase, right? So this is what we talk about leveraging our money. Again, if this if AMC goes up by 10 cents, we would have leveraged our money by $10, right? 100 cents or a whole dollar, we would have leveraged our income by $100, right? So this is what we call leverage income. So leverage income is a step up or a better step than exchanging your time for money, than getting paid per hour or by the hour, or you know paid for a certain time period. You might say we have a project that lasts, a month, and you get paid a certain amount for that project for the month. All of those things are tied to money. Whereas, so that's the worst form or worst way of earning money, which is time for money. The step up from that, as we just said, was leverage income. If you can leverage your money, meaning you do a small amount, but yet you receive many more times the return on the income than you put in. So in our example again, if AMC moves by 1 cent, we receive $1. So we're 100 times or leveraging our effort by 100 times, right? This is the second best way to earn money and the second best way to gain income. So what is the best way? The best way to earn income is passive income. Everybody get that? It's passive income. The word that you must, commit to or be aiming towards is the word passive income. PASSIVE, passive income. So, what does the word passive mean? So, for those that don't even know what passive mean, the opposite of the word passive would be active, right? So that kind of gives you an idea of where we're going with this, right? Active means that you have to do work in order, or active means you're doing work, right? Passive means that you're not doing any work. So when we use the word passive income, we're talking about getting income for not doing any work. Now, it's not 100% no work. Obviously, there's not going to be money for nothing. Nothing is going to be free, right? So when we talk about passive income, unlike leverage income, you do the work, you do the work, and then you get the receipt of the work, multiplied. Whereas passive income is different. Passive income is where you do the work once, and then the money keeps on coming in, right? So you can do the work once, and then there is unlimited amount of times that your income or your profits, or you see the receipt of that money, right? If that sounds good to you, let me get a 1 in the chat. If you would like to, get yourself into an income, a passive income situation where you do the work once and get paid multiple times from doing that work one time, let me get a 1 in the chat to see if that's something you guys are interested in. If you're interested in learning how to do that, or how to get yourself into a passive income situation, let me know in the chat if that's something you want to get into. We get Jeremiah L. Jeremiah L's put more than one ones. He's put multiple ones. We can see D's got a 1 as well. We can see Black Sanzoa. Is it Sanzoa? Good to see you in the chat. Salute. We can see Stun Legacy also as well in the chat. Yeah, right. So this is how you get wealthy, right? Because once you get into passive income, a passive income situation, you do the work once, you get paid multiple times. So why is that good? That is good because not only have you done your work and you're getting paid, you're also now not working and still getting paid, right? So if you're not working and getting paid, what does that free you up to do? Well, that frees you up to get into another passive income situation, right? So now you're getting paid with free time. You can take that free time and set up a separate passive income situation, right? So while you're setting up your second passive income situation, you're getting paid from your first passive income situation, right? And now when you execute your second passive income situation, you are now getting paid twice or 2 times for doing the work once. And then once you, from your second passive income situation, you stop working, you are now no longer working and getting paid 2 times from 2 situations, right? So this is how wealth is built, because your time, your income is not attached to your time. So when you free up your time and then you also gain income from doing that, this is how you build wealth. You've now disassociated your time from your money, meaning you have earned back your time, yet you're still receiving or on the receipt of income or on the receipt of money, right? So in those situations, if you're receiving money without having to work, then what is your wealth? Well, your wealth is then a measure of what your expenses are, right? If your passive income becomes more than your expenses, that is how you become financially free, right? If, say, for instance, you set up one situation where you get passive income on one situation which earns you 5 grand a month, £5,000 or $5,000 a month, and then you set up a second situation which earns you £5,000 or $5,000 a month, and then you look at your expenses for the month, and your expenses are 10,000 for the month. That means you'll be financially free, right? Because you can exist every month without having to work, because your passive income covers all of your outgoings or your expenditure, right? Conversely, like if your outgoings were 20K for the month and you were earning 10K for the month, then your wealth or your financial freedom, or the amount of time you could exist, would be for half the month, 15 days. If you want to say the month is 30 days, it'd be 15 days, right? So again, wealth is a measure of time. How long can you exist and survive and cover all of your expenses without having to go to work, right? So this is what you end up with when you get to passive income, right? So with the aim of doing trading is that setting up yourself in a situation, and you're never going to be in a situation with trading where you're going to be completely passive. But what you can do, you can set up yourself in a situation where you can um, set up a trade, and then you have to do like minor work for that trade, maybe like 20 minutes a day, just monitoring your trade. Yet the work that you've done for those 20 minutes will continue to keep paying off and keep paying you when it comes in terms of returns, right? So again, this is why we like technical analysis over fundamental analysis, because technical analysis can give us a setup that we can use multiple times in multiple situations, and that can continue to pay us, going on, perpetually into the future. See, the issue with fundamental analysis is, each situation is different. When we're talking about different companies, different companies have, different CEOs are producing different products, are in different industries. There are various different, variables for each of these different products. That means that when we transfer to each one of these companies, utilizing a fundamental analysis strategy, doesn't allow us to have consistency between all of them, right? Having consistency in your trading or in your investment is the key to having consistent profits. This is why a lot of people struggle for having consistent profits, right? If you want to know the secret to having consistent profits, is having a consistent strategy. In trading, we call our strategy our edge. Having a consistent edge that you can apply to multiple different assets is the thing in which allows you to have consistent profits on the return. And this is why we like technical analysis, right? The difference between fundamental and technical analysis is technical analysis is using a consistent system, utilizing the charts, utilizing indicators, and losing price, whereas fundamental analysis is a system utilizing news from companies, researching the companies. Ain't nobody got time for that. Who's got time to be sitting there researching what this company is doing, who the CEO is, who is doing what? It's long, right? This is, taking time to do that is something that takes time and doesn't allow you to, as we say, we do 20 minutes a day with technical analysis. We can look at the charts and instantly know whether or not we're investing or not. And we can also know, how to manage our trades when we look at the chart. If you got to start looking at researching who is doing, who is having earnings for this month, what company they're in, who's the new CEO, who's what the central bank is doing, what interest rates are doing, what happened all of that takes up time, right? And having time associated to your investments, again, is going in the opposite direction to what we want to do. So we want to minimize the time that we put into these things and maximize the output of profit that we put into these things, right? So again, this is why technical analysis is good, because technical analysis minimizes our time and maximizes our profits, right? So within technical analysis allows us to have a specific setup, and we have specific indicators that we can utilize to any sort of asset, whether it becomes a stock, whether we're talking about a crypto, whether we're talking about a Forex setup or Forex pairs, or if we're talking about commodities, right? The platform or the landscape is the same in each one of these. So we can apply the same rules and regulations to each. We're not changing or faffing about or trying to do research for each one of these. If you have to keep changing your trading strategy based on the asset, there is no consistency. There is no way for you to judge or to tell if your trading strategy is working, because each asset or each situation is different. You can't apply the same rules from one asset to a separate asset, right? If you're doing fundamental analysis, if you're utilizing the same trading strategy or the same principles to all of these different trading strategies, it gives you consistency along the board. If you're giving consistency with your trading strategy, that is what gives you stability in your returns, and this is what gives you consistent profits on a regular return or regular basis. All right, so what we're going to do is go into how you have setups for consistent returns. I'm also going to speak a bit about when we see people talking about how much they made in a day, right? We see some people saying, yeah, 5,000 in a day. Well, if you don't understand what trading is and how trading works, it's going to be hard for you to understand what it means when traders say that, right? So one of the things we want to do here in Focus on Investing is we want to give you the education and the knowledge of knowing how to understand trading, understand the language of traders, right? Because when we're talking about getting involved in investment, there's a lot of BS, a lot of smoke and mirrors, a lot of salesy or marketing talk that goes around in these investment streets, right? In these streets where people will sell you trading ideas and trading strategies and things like that. There are a lot of things that people say that don't have direct sense or don't make direct sense, in terms of trading. One of them are when people tell you how much they earn, um, you know, per month or per day or anything along those lines, right? So why do I say that these things are, can be misnomers or, be something that is not clear? Well, when we're talking about trading and getting returns in trading or in any type of investment, to be honest, we're looking at dealing with the difference between, you know, um, risk and reward, right? The difference between risk and reward. All investment is risk and reward. Another word for investing is called speculation. When you're speculating, the speculation is another word, you know, speculation is another word for guessing, right? But what separates investing from guessing is, strategy, or what we call our edge. Our edge or our strategy is what separates it from guessing. When we're talking about something like maybe like a roulette table or roulette wheel, you've got almost 50-50, like red or black. Obviously, if you know about roulette trading, you have a green. So there's a percentage of it that is based on the green. So if we're going to say in our example that there is no green, we're just going to say there's red and black, you have a 50% chance of having red or black. And there is no real strategy to, betting between red or black in something like roulette on the roulette table, right? Um, if anybody has ever gone to the casino and bet on roulette, there are patterns that do form in the roulette table that you can kind of take advantage of. But generally, it's a 50% chance, right? And that is what you would call guessing. Well, as traders or investors, we don't want to be guessers, right? We want to increase our percentage of guessing and weight the outcome in our favor to remove it from guessing. And this is when we start going into investment, because we have a strategy, right? We have an investment strategy that allows us to control the outcome, or at least somewhat predict the outcome of what the trade would be, right? Once you start predicting or controlling the outcome, you move away from guessing and you move into investing, because you have an investment strategy. That's where the strategy comes in, where you start controlling the outcome or the parameters of the investment, right? So this is what we do. So when we talk about, strategy or speculation, we're talking about the balance of risk versus reward. All trading is risk versus reward. And if you know anything to do with risk versus reward, you have, risk. The more or greater the risk you have, the greater the reward. And the least the risk you have, the least the reward you have. So the greater the risk, the greater the reward. The least risk, the lesser the risk in the trade, the lesser the reward you have back, coming back, right? So the secret to having good trading strategy or good trading etiquette or building a good trading situation is minimizing your risk and maximizing your reward. Okay, always remember this, minimizing your risk and maximizing your reward. Okay. Shout out to Keystone. I see your message in the chat about need your email. I can definitely arrange to give you that. Jeremiah L says the art of war and trading all day long. Yep. Everything is about strategy, right? And this is why we're here at Focus on Investing, right? It's about educating you to understand trading strategy, right? There's a thing called the Dunning-Kruger scale. Put a 1 in the chat if you've heard of the Dunning-Kruger scale. If you've heard of the Dunning-Kruger scale, let me get a 1 in the chat. If you haven't heard of the Dunning-Kruger scale, put a 2 in the chat. If you've heard of the Dunning-Kruger scale, let me get a 1 in the chat. If you haven't heard of the Dunning-Kruger scale, let me get a 2 in the chat. So let me bring this up. So Black Sanzoa says 2. D says 2. Mo says heard about it, but don't know. Okay, we're going to break this down. So this is important in terms of, anytime you're learning a new skill. And again, especially with trading, it's important to know this. Let's go see. All right, let me see if I can bring this image up. They call it the Dunning-Kruger effect. All right. Let me share this screen. Let me stop sharing this. Let me see if I can share. Let me share this screen. All right, so this is the what we call the Dunning-Kruger scale, or the Dunning-Kruger. It's also known as the Dunning-Kruger effect as well. And it measures two things, right? When we're talking about the Dunning-Kruger effect, we're talking about, so Dunning-Kruger was, I think, the surname of two different, I guess you would call them scientists or theorists, who came up with this study. It was a scientific study, right? And the study is the talk about the difference, or the measuring between, confidence and knowledge, right? And it goes about to speaking about, when you, how much knowledge you have versus how much confidence you have, right? And what you tend to find out, like, it's basically, there is those things that those things that you don't know, there are those things that you don't know, and there's things that you don't know that you don't know, right? So you have four different separate categories of education, of what you know, right? And where when you start getting knowledge of things, right? So the things you have the most knowledge of are things that you know that you know. The things that you have the least knowledge of is the things that you don't even know that you don't know, right? And then the range goes through all of those things. As you move along that scale of knowledge, from ignorance to knowledge, your confidence levels change, right? So, you know, things that you comfortably know, or comfortably and confidently know, your confidence is at the height of those things, right? The things you don't know, because you don't even know them, you don't have really a scale of confidence of knowing those. So the things you don't know is the things that where your confidence is the lowest, right? So the Dunning-Kruger effect talks about, the range of confidence going through that. Why is the confidence important? Well, the confidence is important because, the offset of the confidence is ignorance. The last thing you want to be doing is being ignorant when it comes to investing or investing your money, right? You want to have confidence, but, you want to have true confidence, right? The issue we have these days is, the term confidence has been misled, or it's been misguided, right? People nowadays use the word confidence as a replacement for the term lying, right? People will say, if I pretend like I'm confident, then I'm confident. No, that is not confidence, right? A lot of people say, well, if I get this new makeup, this new makeup gives you confidence, so now I'm confident. No, 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 no. That is not what confidence. See, the new age, or the new, the new era of emotion, we've moved out of the era of, facts, right? And we're now into the era of emotion. So a lot of people act on emotion. They don't act on facts and what is correct, right? So when you're dealing in an era of emotion, what you feel now becomes, the quote unquote fact or truth of what a lot of people operate under, right? So this is why everything is about feelings, right? How people feel. People, feel offended. So that's why people get in trouble, right? Because of feelings. We're in the era of feelings. The issue is, we can see the madness that happens, in our society now, when everybody is having feelings. You can't even say anything these days without people being offended, right? People get offended because of how they feel. You can get, in trouble because how somebody else feels about what you have said, right? But remember, offense is never offense is always taken. People always take offense. Offense is never given, right? People have to become offended by what you're saying. Nobody, you can never really offend somebody. Somebody has to be, they have to take offense to what you're saying, right? So it's about how people feel, right? So in this new era of feelings, confidence is about how you feel. If I feel confident, then I can appear to be confident, right? But that's not real confidence, right? Just because I've got a new lipstick on doesn't mean that I'm actually confident because I'm lying about my confidence. That's just another word of lying or pretending. And pretending is not true confidence. What does the word confidence mean? Well, confidence means, your ability to either control or predict the outcome of something, right? This is what confidence is. Confidence is your ability to either control or predict the outcome of something. This is what you're saying you're confident in. You're confident in the outcomes of the thing, right? This is what confidence means, right? It's a measure of, well, how do you get confidence? You get confidence from experience, right? When you're experienced in something, you've been through a situation enough times in order to to be able to control or to be able to predict the outcome of something. This is not your first rodeo. You've had that experience, right? So this is why, it's a misnomer, or it's bad advice when people tell you, oh, just be confident, just act confident, right? How can you be confident in something you've never done before? If you've got no experience of something, how can you be then confident in it? You can't, right? So this is the difference between reality and with lies, right? When people are saying just pretend to be confident, what they're really telling you is to lie, or to have the false confidence state, you know. And this is where the term "fake it till you make it" comes in, right? Fake it till make it works in certain situations, but it's not confidence, right? Because you can't confidently do something you've never done before. It's like saying, you know, you're going to take somebody to somewhere you've never been, and they've got to confidently navigate you around the place, right? It's not a possible thing to do because you've got no experience of doing that thing, right? So it's not possible for you to have confidence in things that you don't do. So true confidence is confidence in being able to control or predict the outcome of events. And false confidence is just pretending like you're confident about something that you've never had experience in, right? So once we understand that, now we can take a look at this Dunning-Kruger effect, or the Dunning-Kruger scale, right? So when we're talking about the Dunning-Kruger scale, we talk about, the beginnings at this point here of our knowledge. This left-hand corner of the knowledge scale, is talking about the least amount of knowledge you have. When we're talking about this other line, which is the far corner, we're talking about the most amount of knowledge that you have, right? So this is talking about the growth of your knowledge going through, time. As you grow and gain more knowledge, you move along this bottom scale. So you'll move from left to the right hand side as you gain more knowledge. The scale, or the axis moving upwards, is the confidence. This talks about how much confidence that you have in a certain thing. What is interesting is, when you're talking about the beginning, we're talking about having no knowledge. When you have no knowledge of something, you have no confidence in it, right? Why? Because we're talking about the things that you don't know that you don't know. You have no knowledge of the thing, so you don't even know anything about it. So therefore, you don't have any confidence in it. And this is where, a lot of people are when they first get into trading. When they first get into trading, they're in a situation where they don't know anything about trading, right? Or investing. They will hear the term about trading. They'll maybe hear the term stock market, or, cryptocurrency, or something along those lines. And they will have no knowledge of exactly what that thing is, right? They don't know, how to invest or anything, probably other than the name of what it is. Yeah. So unconscious incompetence, as Jeremiah L has said, right? And then you start to, hear a bit about investing, hear a bit about trading, start to get a bit of knowledge about yourself. And as you start getting some knowledge of the situation, your confidence starts to, you starts to grow, right? You start to grow a bit because you start understanding terms. Oh, what is a bull market? What is a bear market? What is bullishness? Oh, Bullishness means when the price is going up. Bearishness means when the price is going down. So you're gaining knowledge. It's the gain or the receipt of knowledge that gives you the confidence in the thing, right? So the gain of knowledge is what grows your confidence in this thing. But here's the trick: what happens, right? When you first start getting into any situation, you gain the knowledge generally of the good things that happen, right? So, like with anything, the the experience the experience is generally experience of bad things, right? That is the thing that separates the people with experience from people that just come in. When you just come in to anything, you get experience with the obvious or the freely observable things, right? So you are really experienced. But the issue is, when it comes to in terms of things that are not apparent, right? The threats that lurk in terms of anything that you undertake, right? It's the threats that is what you need to be watching out for. And this is where you have the thing what you call like false confidence, right? You get false confidence because you become overconfident or have a full sense of security because you think that you know everything at that point, and you haven't had enough experience or enough time in the game to be able to see and understand the pitfalls, right? So let's go, for instance, I use an example of the most recent collapse in the cryptocurrency markets. We had a massive you know fall of, or let's say, you know let's talk about like maybe you know a cryptocurrency going for a pump and dump, right? Or no, let's not even go and say that. Let's go and say, let's talk about a bear market, right? Most people haven't had the experience of a bear market. Most people, have come into investing, whether it's cryptocurrencies, whether it's Forex, whether it's stock market, they've all come in on a bull market. If you've only come in a bull market, you can be lured into a full sense of security in terms of what it takes to invest and, the pitfalls or the dangers or the risk of investing, right? When we're in a bull market, as the saying goes, a rising tide raises all ships, right? So in a bull market, it's harder for you to not make money than it is to make money, right? Because everything is going up, right? And in the terms of Fat Joe, nothing can stop it. It's all the way up, right?
Nothing can stop me. I'm all the way up.
Everything is going up when we're talking about a bull market, right? Bull market, assets are raising, the markets are raising, everything is raising. So essentially, anything that you put money into starts raising. So if you come into the investment field when we're in a bull market, you're more than likely going to make money with assets. The issue comes when we start rolling off from a bull market into a bear market. So this is what we're facing now. We're looking at a lot of the markets are on a downturn. We just had a massive dip in the crypto market, and we're seeing a lot of bullish activity and bearish activity in the crypto market. We're also seeing a lot of the indices in the stock market are becoming bearish. So we're seeing a lot of bearish activity in the stock market as well. So what happens is those that came in to investing, or those who are used to a bullish environment, when it becomes bearish, they become overly confident, or they have a full sense of security because they think we know everything. I've been in investing in such a long time, but they don't realize at the time that they've been in, it's been all only bullish. Now, when it becomes bearish, there are increased, threats that weren't in there before that they're not aware of because they haven't been in a situation like this before. So they have a full sense of security, thinking they have experience of the landscape, but the landscape has changed. Let me get a 1 in the chat if you've only come into investing while we've been in this bull market. Let me get a 1 if you've been in this investing in bull market. If you've been investing or if you've invested during a bear market, give me a 2. So if you've only been investing in while it's been a bull market, let me get a 1. And that depends whether you've been investing in crypto, whether you're investing in stocks, in Forex, or anything like that. Or if you have bear market experience, let me get a 2 in the chat. If you've only been investing in about the last few years, 2-3 years, you've only been investing in bull markets. And if you've been around a lot longer than that, then you've probably experienced downturns. Maybe in 2008 when the market collapsed, 18 as well, we had a little issue. That would be a 2. So if you've been invested in bull markets, let me get a 1, excuse me. And if you've been invested in bear markets, let me get a 2. Jeremiah L says 3. I don't know what that means. Maybe that means both. I'm going to assume, Jeremiah, that means both. So you've experienced both, right? So some people have had both. Most people have not invested in both. They've only invested in either a bull market or a bear market. And again, because we've most recently only seen bullish activity in the markets, most people have probably only invested in bull markets. Yeah, Jeremiah L says a little bit of both. All right. So because most people have only invested in, bull markets, when the bear market does come around, most people are lost and they have, false confidence because they think the landscape is the same, but the landscape has changed, right? So when we're talking about the Dunning-Kruger scale, we're talking about people that have so much confidence, when they first get into it, that they don't realize that they don't have knowledge of everything. They have a knowledge of some things, of small things of a situation, but because they haven't been around long enough, or they don't have enough knowledge, they don't have enough knowledge to know what they don't know, or they don't have enough knowledge to know the threats or the dangers in the things, right? Because they come in, they get a little bit of success, they get overconfident in what they're doing, and then they end up causing themselves issues because there are gaps in their knowledge, but they don't even know they have gaps in their knowledge because they don't know enough about a subject in order to see the gaps in their knowledge, right? So again, when you come into a field, most you start to get an understanding of what it is, but you don't have enough understanding to know what you don't know. So this is where the ignorance is at the most. This is where they say the peak. So what is interesting, the peak in the beginning is higher than when you become an expert. Why does that happen? Well, that happens because as you start learning and you have more experiences, you start getting bear market experience. So this dip here would be an example of bear market experience. You've been in it long enough to know that, to have an experience of the bullishness and the bearishness. So once you start having experience of bearish activity, and you also are in the field long enough, you start getting experience of the bad things that can happen, right? You start having the understanding, or you start gaining awareness of the bad things that can happen. You start becoming aware of the pitfalls that can happen in a bear market, right? So once you start understanding and identifying the dangers, you start, tempering or modifying your arrogance and your ignorance and your confidence, so it starts coming back down again. What's interesting is, once you start learning about the pitfalls in any sort of investing, your confidence drops right down, because you start to, at this point, understand that your confidence was false confidence, right? You were overzealous or overconfident when you first came into the thing, and then as you start understanding there is more to these things to learn, you start gaining some humility, right? It starts coming back down. But then what happens is, over time, as you start learning, you gain confidence, because now not only do you just know, the thing, you just started learning, basic principles. You then start learning expert principles or more or deeper principles. And then as you start doing that, you start getting a whole rounded or wholesome knowledge, in the situation, right? And this is the curve for focus on investing, right? Most people have come into investing maybe, in recent times. They've got excited, they've heard the terms about, stock market or crypto or Forex or investing in gold or something along those lines. Most people, you know, don't know too much about it. They hear the ideas of investing. They want to get invested, start putting some money into some of the markets, get a bit excited and get a bit overconfident because they might have got a bit of returns in the bull market and they get in the peak, right? Then what happens is, they get overconfident, thinking that they know everything because they've got a little bit of success and they've got into things. And then along comes, focus on investing. And as focus on investing starts coming in, we start teaching you about, chart patterns, understanding how to read indicators, how to look at and understand and read good chart patterns and what a good investment is. And what happens is people's confidence starts going down. But notice, even though their confidence goes down, they're still moving along the knowledge scale, right? As your knowledge increases, your confidence goes down. And it's not that your confidence goes down, it's that your false confidence goes down. All right. The reason why it's your false confidence that goes down and not your actual or your true confidence that goes down is because as you go through and you gain knowledge, you're also gaining experience, right? Remember, it's experience that gives you the confidence. It's experience that gives you the confidence and it gives you the knowledge, right? It's not false confidence, right? Here is false confidence. When you're talking about the height of your confidence, you're talking about false confidence. But here, as you start gaining knowledge, you start gaining experience, and that is why your confidence goes down because you're exchanging false confidence for true confidence and true experience and true knowledge, right? And then as you move, this is how focus on investing comes in. It starts giving you identification of that what you thought you know, and now you realize that you don't know, but now you're learning, right? So now your actual knowledge is gaining. So you start tempering your false confidence and it dips, and then over time you start growing as you start coming towards growing towards an expert. And this is what we're here for in Focus on Investing. In Focus on Investing, our aim is to make you experts in the things, not just to have false confidence in, knowing surface level information, but we want you to be experts in learning exactly what it is that you know and know it inside out, back it up with facts confidently, being able to know what it is that you're investing in. Mo says crypto, both bull and bear stocks just recently. Uh, Most recently, stocks on the way down. I'm in commodities. All right, so Mo is in a good range of everything. He's in crypto. He's experienced bull market, bear market. Also most recently stocks on the way down, and he's in commodities. All right, that's a good sign, right? So again, yeah. So we're talking about the difference between the confidence gap between somebody who's just knowing about a new issue and an expert in a situation. Again, guys, if you haven't already done so, hit that like button. If you haven't subscribed, hit that subscribe button. Also, if you would like to support the stream, you can hit the Cash App. The Cash App is on the screen, British pound sign, and then focus on investing, the British pound sign, and then focus on investing. All right. So when we're talking about, we're talking about the difference now between people who are just having surface level information in trading and experts. Why is that important? This is important because, when people talk about, how much they make, every day in trading, or how much they make in a month, or how much they make in a week, they can tell you how much they make in a week or a month or in a day, but it doesn't really mean anything. But it sounds good to you because you don't have knowledge or full knowledge of trading to really understand what that means, right? So if you have surface level information, that can be impressive to you, because you don't know what you don't know about those numbers or those metrics or those statistics. Does that make sense? Right? So this is why I speak about the difference between being an expert and being knowledgeable and being on this side of the scale versus, having maximum confidence but being ignorant. It's those people who are ignorant, who don't know a lot about trading, but just know enough about trading in order to get bamboozled when you hear people talking about how much they make a day or how much they make in an hour or all of those things, right? Because you don't have a true understanding of how trading setups work in order to make sense of what it is they're telling you when they tell you those things. Does that make sense? Okay, so now we're getting back into our talk about risk versus reward, right? The reason why this is important, if you don't understand your risk versus reward setups and how that is calculated, what your return is doesn't really make any sense, and it doesn't. It's not that impressive, right? So when you invest into any sort of assets, whether it's stocks, whether it's cryptocurrencies, whether it's forex, or whether it's any sort of investment in terms of commodities, how many of you know what your risk versus reward ratio is in your investment? So let's take, for instance, whatever your last investment was, if it was in crypto, if it was in stocks, if it was in buying gold or commodities or anything like that, do you know what your risk versus reward ratio was in that investment? Let me get a 1 if you understand how to calculate your risk versus reward strategy, or give me a 2 if you don't understand how to calculate what your risk reward ratio was in your last trading strategy. So in your last trade, put a 1 in the chat if you understand what your risk versus reward ratio was in your last investment, and put 2 if you don't understand what your last risk versus reward ratio was. Jeremiah L says 2. So that means you didn't understand what your risk reward ratio was. Okay. Again, put a 1 if you understand how to calculate your risk versus reward in terms of an investment, and put a 2 if you don't know how to calculate your risk versus reward in terms of your investment. Let me give you guys a few seconds on how to respond to that. Yeah, remember, if you haven't done so, hit the like button, and if you haven't done so, also press the subscribe button. Want to give a shout out to, let me check it on, let me just check my Cash App. Let me make sure I call out the right name. Yep. Let me give a shout out to Luciana for supporting the stream with the Cash App. Much appreciated. Again, thank you for investing in the information. Again, if you find this information valuable, invest in this information, and we can keep this information going. We can all learn together and improve our investment knowledge as well. So again, shout out to Luciana for putting some money on the stream and helping support the work that I'm doing out here. Thank you very much. All right, so most of you said 2. So you don't understand how to calculate your risk reward ratio. Well, let me explain why it's important, right? So let's say, for instance, I told you that today I made 1,000. There you go. Salute, Luciana, for the support of the stream. Much appreciated. Much appreciated. Yeah, let's say, for instance, I said I made, if I make $100 today on on a trade, is that a good return or is it a bad return? If you think $100 is a good return on a trade, press 1 in the chat. So $100 for the day is a good return on a trade. Press 1 in the chat. If you think $100 for the day is a bad return for the chat, for the chat, I'm getting myself confused. If you think $100 is a bad return for an investment, press 2 in the chat. Again, press $100. Press $100. Press 1 in the chat if you think $100 is a good return for a trade in one day. Press 2 in the chat if you think $100 is a bad return for an investment for one day of a trade. I hope that was clear. I know I was a bit confusing myself. So 1, if $100 for the day is a good return for an investment, and 2 in the chat is a bad investment. Let me give a shout out to Jeremiah L. again for supporting the stream. Much appreciated for your support of this stream. Again, your support allows us to keep these streams going. If you find it's information informative, and you would like to see me continue doing these streams, then again you can hit the Cash App. The Cash App is #, focus on investing on this screen. So again, shout out to Jeremiah L for supporting the stream. Again, Jeremiah L and Luciana have supported the stream. Thank you very much. It's much appreciated for your support in this stream. So we've got Jeremiah L with 3, our supporter for the day. He says 3, it depends. And also Luciana has also said it depends, but 1. So we've got a bit of fence sitting. Luciana says it depends, but 1, right? So okay, so we're kind of divided. So we've got a maybe and a yes, it's good. Okay, let me ask the question. If you got $1,000, right? So if you got $1,000 for a trade in one day, is that a good return? Let me see a 1 in the chat. If you think if $1,000 is good return for for a trade in a day, and let me get a 2 in the chat if you think $1,000 is not a good return for one trade in one day. We're much more certain on this one. We've got Jeremiah L with 1. So Jeremiah L thinks yes, $1,000 return for the day in one trade is a good return. We've got D also saying 1. D says $1,000 return a day for a trade is good. And then we have Luciana that also says that $1,000 for a day return for one trade is a good return. Anybody else wanna give their opinion before we proceed? So the general consensus of the chat is that yes, that is a good return in terms of investing. So which is the correct answer? Well, the correct answer out of all of them is actually 3. So it's kind of a trick question, but not really a trick question. So Jeremiah, you were correct in terms of 3 in saying it depends. I will give Luciana props as well, because Luciana did say it depends, even though there's a but 1. I'm gonna ignore the but 1, and I'm gonna err on it depends. Now here's the thing. Why do you guys think it depends? Now that I've told you it depends, for what reason or what does it depend on? Right? So what does it depend on whether $1 return a day is a good return on an investment, or $1,000 a day is a good return on an investment? All right. So we've said that it depends. Let me hear chat. What is your reason on what does it depend on? What do you think it depends on? Uh-oh. Uh-oh. We got people from Focus on Investing. We got people. We're coming along the expert curve. We got experts in the building. Yeah, I don't even want to put it up on screen yet. Just I'm gonna see what people are saying. Uh-oh. We can see we've got people that are paying attention. You got people that are paying attention. We got Focus on Investors in here. We got investors from the community in here. Yeah. So we're gonna start with Luciana. Luciana says absolutely correct. How much it put in, or how much we put in, right? Mo says how much we risking. Exactly. How much we invested initially, right? You guys are on it. You guys are part of the Focus on Investing community. You know what time it is. We know what we're doing over here. All right. So yeah, you know, exactly the point. How much are you risking, or how much you're investing? So yeah, let's go with what Mo said, because he used a keyword there, which is risking, or what we call risk, right? It's your risk that really determines whether or not you have, whether it's a good trade. Because we hear, like, good investing is not gambling, right? So if you're not gambling, you're dealing with investing with a good strategy. A good strategy has a controlled setup. You're not going Hail Mary and just throwing money into a trade and hoping it comes back, right? All of our money is hard earned. A lot of people, did like a hard 9 to 5, lots of hours in order to earn the money. You don't want to then waste that money by throwing it away in a gamble, right? So we want to have a properly controlled environment and invest our money correctly. So in order to do that, you also have to control your risk reward ratio, right? So you don't want to take ridiculous risk in order to get minor reward, right? So when people are telling you how much they earn for the day, like if it's $1 for the day, $100 for the day, or $1,000, what they're not telling you, and this is where the expert, the experience, and the knowledge comes in, is they're not telling you what their risk reward ratio was in order to earn that, right? Because when you think about it, right, whether or not $100 a day was good or not depends on how much they risk in order to get that. So if I put $1 down and got a return of $100, right, that's a great return. But imagine I'm a billionaire. Imagine I'm, you know, Elon Musk out here. I'm Elon Musking it up in the markets, right? And I'm a billionaire, and I've put $1 billion down on a trade. And out of that billion, I've got $100 for the day return. Is that a good investment? Let me ask you guys, if would you guys be happy with that return? If you put $1 billion up and you received $100 return, would you be happy with that investment, or with that return? Sorry. So put a 1 in the chat for yes. Would you be Jeremiah's already on it? Would you be, if you put a hundred, if you put $1 billion up and you got $100 return, would you be happy? Is 1 is a yes, you'd be happy, and 2 is a no, you wouldn't be happy. 1 is a good trade, and 2 is a bad trade. can see Jeremiah L. Bad trade up front on deck. You got Luciana as well saying two, bad trade as well. Yeah, right. It's a bad trade. It's a bad trade because the risk reward ratio doesn't make sense. It's not impressive, right? So yeah, Mo said, "Yikes, hell no," right? Because and this is the difference between being an expert in trading and being ignorant in trading, right? Once you start getting proper knowledge of what makes up a trade, you understand that there's risk and reward in a trade, right? You start to see through the BS. People cannot, mislead you and give you fancy statistics and things like that by telling you how much they made. It's not important because you don't know how much they risk and what their setup was, right, in terms of their trade, right? So, again, in Focus on Investing, we aim on making you experts in understanding the ins and outs of the setup of a trade so that you can have full knowledge and you can know who's really doing investing the right way and who's really making money and who's not, right? So, how do you calculate the risk versus reward of a trade? All right, let's go to trading view and look at how we're going to calculate that, right? So let me pull up my trading view screen. Yeah, let me go. Okay, yeah, let me switch my screen out this way. And we're gonna take a look at how we calculate our risk reward and you can understand whether a trade is good. And then also we're going to show you the benefits of how we do our focus on investing situation, right? So let me switch. Nope, I don't want to do that. I want to do this. There we go. So I'll bring the screen up a bit better. All right, how do we calculate our risk versus reward on a trade? Alrighty then. So in our example, we're going to use AMC, the controversial AMC. All right, so let me see if you guys know your trading. In investing, how many directions can a trade move? This is the question for the chat. In investing, how many directions can a trade move? Or in how many directions can price move? The question for the chat. In trading, how many directions can price move? And this is in any sort of investment, right? And this is general. All right, we've got answers coming in already. I'll give you some time to get your answers in. The question is again for the chat. In trading, how many directions can price move? There are no wrong answers. Well, there are wrong answers, but don't be afraid of a wrong answer. It's better you guess and test your own knowledge. Again, this is how we become experts. Don't be afraid to guess. And this is how we learn and we improve our knowledge, right? So we've got Luciana. Luciana has said 3. So 3 directions. And Luciana would be correct. So price can move in 3 different directions when we're talking about price. It's technically 2, but because we're moving forward in time, we can count the third one, right? So where are we at? Here. So the three directions that we can move in price. So Jeremiah L says 2. No, the correct answer would be 3. So the correct answer is 3. So we can move up. We could also, price can also move down. And then price is technically can move sideways, right? So you're technically not moving when it's going sideways. When price is moving sideways, price is, price is stuck at the same price. But because we're moving forward in time, we consider that price is moving sideways, right? So if we take price over a certain range or amount of time, we can more easily see that price has moved sideways, right? So I see you've got a question mark on 3, Jeremiah. So technically price only moves up and down, but because we're moving forward in time, the forward movement of price not moving up and down, we will class it as a third direction, right? So look at it. If we were looking at it like in the roulette table, we would have red and black for up and down, and then green might be sideways. It might be the kind of third direction that we're looking at, right? So generally, when we're looking at sideways movement, we're talking about over a range or a period of time, right? We're talking about, if we go for any individual amount of time and any small amount of time, price is always constantly moving up and down, right? It never really stays the same. But when we talk about sideways price movement, or we're talking about the chart moving sideways, we're talking about, over a range or a period of time, right? So if we were to take a closer look at this AMC chart, we could say that, and if we zoom in a bit more, if we were to section off price, right? Let me bring up my indicator. We're going to, let me take this one. So if I was to take price, I'm going to zoom in a bit closer. This is where we start getting into technical analysis. We start to analyze charts and understand charts. All right. So if we were to take price from this period between here and here, so in this blue section, extend it. All right, so we're in this blue section. So where we've highlighted in this blue box here, we've highlighted between these ranges. Let me give you between there we go. Between these two red lines, has price moved upwards, downwards, or sideways over that time? So between the two red lines, has price moved up, sideways, or downwards? This is not a trick question. This is pretty simple. So don't feel scared of answering the question. In this time frame, has price moved upwards, downwards, and sideways? Remember, we're talking about over a range of time. So between the two red lines in the blue shaded area, has price moved upwards, downwards, or sideways? So we have Luciana saying up. So Jeremiah says looks like a mix of up and sideways. Anybody else want to take a guess? Between the two red lines in this blue shaded area, has price moved upwards, downwards, or sideways? I'll give you a few more seconds if you want to answer. Again, if you haven't done so already, hit the like button on the stream. You can hit the subscribe or you can share it. And also, if you would like to support the stream, like Jeremiah and Lucian has already done so, you can hit the Cash App on the screen, which is British pound sign, focus on investing. All right. So the correct answer is price in this time frame has moved up. How do we calculate that? Well, the simple way to calculate whether price has moved up or not is simply to look at the first time frame, which would be here, 21st of May, 2021, and what the price was for 21st of May, 2021. The price was around, I think this is it here. It's around $12, $11, $12, let's say roughly. And then the closing of this time frame at, the 4th of June, 2021 was around $57 or so. So that's the simple way of how you would calculate it. You take the price at the first point, you calculate the price at the second point, and if the price at the second point is higher than the first point, then price is moved up, right? Price is moved in the upward direction. That's the most simple way to do it, right? Obviously, like you can see on the chart by visually as well, but again, if it's not clear, you can't it might not always be the easiest way to tell. All right. So the second question, I'm going to move this line here. We learning today. All right, chat. So between these two red lines, and the blue shaded area. Same question again. Between these two red lines and in the blue shaded area, has price mostly moved up? Has it moved down, or has it moved sideways? Has price moved up, down, or sideways between the two red lines and the blue shaded area? Remember, price can only move in three directions: up, down, and sideways. So between the two red lines, has price mostly moved up, down, or sideways between the two red lines in the blue shaded area? We look at chat. Luciana has said sideways. Mo has said sideways as well. Anybody else wanna hazard a guess? We've got Jeremiah L saying sideways as well. Yeah, so between the two red lines in this example, or in this instance, between the 14th of June and the 2nd of June, overall, prices moved sideways, in a sideways direction. That is correct. All right. So for our third and final question and third and final answer, we're going to move the lines again. We move our blue shaded area. So between the two red lines and the blue shaded area, has price mostly moved upwards, downwards, or sideways? Between the two red lines of the 29th of June 2021 and the 16th of June or 16th of July, 2021, has price mostly moved upwards, downwards, or sideways? between the two red lines and the blue shaded areas as my price mostly moves up, down, or sideways. So Jeremiah L has said downwards. Luciana has said down. Anybody else want to hazard the guess before we give you the answer? Yeah, so the correct answer is down. Yeah, price went down, right? So it's not that hard to, yeah, most is down at the buzzer, fourth quarter. So price went downtown, right? So we understand that price can move in three directions, right? So now that we understand the three directions that price can move, when we're talking about speculation, essentially what speculation is doing, speculation is you betting or going against the broker or the market and guessing in which direction price is going to move. It's going to either move upwards, downwards, or sideways, right? Now, here's the thing. If price moves sideways, it's very hard for you to make money because we make money in investing by price movement. If price is moving sideways, that means it's not really moving up, it's not really moving down, it's just kind of staying around the same price. If it's not moving, then there is no opportunities for us to make any kind of money, right? Now, remember, we can make money in both directions. We can make money when price is going up, bullish, by buying, and we could also make money when price is going down in a bearish situation by selling or shorting. If you want to understand how to short or how we make money when price is going down, then refer to last week's live stream where we covered, what is shorting in the live stream, right? So we need price to be going up and down in order to make money, right? So let's say, for instance, so we're not going to cover what shorting is and what buying is pretty, pretty obvious and pretty standard, right? So let's say, for instance, let me give a bit more of a zoom. So let's say, for instance, price is where it's at now, which is at $12.03, right? If we draw a green line, we're going to say this line here, maybe here. Sorry. This line here, say that our green line, this is where price is, and this is where we're entering, right? Let's say, for instance, we perceive that price is going to rise and raise up to our previous high level, which is here. Say this of $15 level. We can see that previously in previous trading history, that within AMC there's been an area of support and resistance around the $15 level, right? Previously on its way down, it is hindered or halted or slowed itself down or slowed its descent around this $15 area. So, we know when we're talking about, technical analysis, that all assets have a nature or they have certain characteristics. And those characteristics are based on the underlying asset, which would be the company, right? For whatever reason, these companies are valued or have a general consensus of value at certain price points, right? Because there is a certain consensus of value at certain price points, for various different reasons, you will see this being displayed or exhibited in any sort of chart formation of an asset, right? So in this example, for some reason, whatever reason, we can see that around the $15 area of AMC, the market had a general consensus that, during the time of the 26th of April to the 5th of April, or 5th of May, sorry, that AMC stock was valued around $15, right? And we know from, experience of technical analysis, remember, technical analysis is ultimately at its heart and at its core is pattern recognition, right? So we know in the history of technical analysis, in pattern recognition, what has happened previously in the past is more likely than not going to happen in the future, right? So if we look behind, or no doubt, look, without even looking, we can see that if we draw a line at this $15 area, see that, by zooming in, at this $15 area, we can see not only did price act as an area of support and resistance, as we said, in its 29th of April type of time, we can see that we got a bit of a bounce here in, 21st of March. We can see that we had another bounce here around the 10th and 7th of March. We had another bounce here, 24th of February. And repeatedly throughout history, we can see that, there's something about AMC that it acts as a level of support and resistance around this $15 area, right? So if we use this as the basis or the setup of our trade, and we believe that price is going to go up, it would be a good shout that price is more likely than not going to be, when price does move up, if price does move up, that it's going to head towards this $15 area, because in the past, the market has had consensus that the value of AMC, being at $15 is something that's happened before in the past, so it's more than likely going to happen in the future, right? So if we're going to say that this is the area that we're going to head towards in trading, the place that you expect price to head towards, they call that your target. It's basically the target price, or the price that you're targeting with your trade, right? So for our target price, we're going to say in this example is around, it's $15, which is $15.36. So we're going to turn that to a golden color to represent, the gold that we will receive in our winnings, right? So we have, from $12 to $15, right? So we're not going to go in exact numbers, but we're just creating principles here, right? So if we also look at our previous history of this most recent stock, we can see that our most recent lowest low is around $9. So it's around $9 for this stock, right? So if we see that, $9 is our most recent low for this stock, then it would add to reason that, if this is our most lowest low, then if price, reaches this lowest low, and let alone reaches it, if it breaks and closes below this $9 area, it stands to reason that our guess or our gamble or our speculation that price movement to go up was wrong, right? We guessed incorrectly that price was going to go up, and then price actually went down to our most lowest low. If this is the case, we can then, consider or reason that we were wrong in our estimation. Now, here's the thing with trading and investing. Nobody can ever guess the correct answer in trading. You can never predict whether the price is going to go up. You can never predict whether price is going to go down. And you can never predict whether price is going to go sideways, right? So, if anybody tells you that price is going to go up, price is going to go down, then it's just basically a guess. Again, people are just, that's what you call fundamental analysis, and people are just making it up, right? No one ever really knows, because no one can predict the future. And the aim of being a good trader is not being able to predict whether price is going up or price is going to go down, but it's about having a strategy or an edge that creates a situation that allows you to benefit from price movement, however it plays out. So how do you do that? You do that by in trading, the idea is to, again, because you can't predict which way it's going to go, the idea is to put the odds in your favor of trading. So we call it a high probability environment trading, right? We want to increase the probabilities of our trade, going in the direction that we want it to go or that we predict it will go, right? So we want to create a high probability environment to increase the odds in our favor. But again, it's high probability. So even though something is highly probable, it's not guaranteed that it will go. So because it's not guaranteed it will go, we want to have what we call risk management. We want to manage the risk, right? So when we call it risk management, we're managing the risk because we are calculating that it's a possibility that we will lose trades. But even though we will lose trades, the losing of trades in our investment strategy will not cause us to lose overall, right? So this is what we want to do. We want to manage our trades. And how do you manage your risk? You manage your risk by including or introducing what we call a stop loss into our trading. So what is a stop loss? What a stop loss does exactly what it says on the tin, right? It stops you from losing. So if you incorrectly guess the direction in which your trade goes into the market, the stop loss will stop you losing money, right? And this is where people end up in problems with their trade. So if we talk about the most recent crypto market crash, some people have lost 90% of their investment portfolios and all of those things. People lost how much money in their portfolio. The reason why people are losing money is because people do not have a proper risk management strategy. Let me see this again. If you lost a lot of money in the most recent crashes, this is a sign to yourself that you do not have a proper trading strategy, and you do not have, within your trading strategy, you do not have a proper risk management setup, right? This is an indication to you. If you've lost, again, a lot of money, you don't have a lot of risk management. All right. And then we just take a look at the chat. Jeremiah says $9. That could potentially be a new support level. Okay, Jeremiah, we're going to come back to that comment. And then Mo said, are your indicators saying that price is coming down, or am I mistaken? So, yeah, no, you're correct. So the moving averages would indicate that price is going down, right? Remember, the moving averages represent the price over time, right? And you can identify it in two different ways. The first way is basically the angle of the moving indicators. So again, if the left-hand side of the moving indicator is higher than the right-hand side, price is indicating that price is going down, but also the order of moving indicators, right? So we have three moving indicators here. We have the 200 simple moving average, we have the 50 simple moving average, and we have the 20 simple moving average. If we're ordered with the slowest moving average, or the one with the highest number at the top, and the lowest number, or the fastest moving at the bottom, that means we're ordered in a bearish situation, and that indicates that price is going down. The third way you can tell is whether or not the indicators are above or below price. So in our instance, because the indicators are sloped downwards, that is our first indication that price is on its way down. The second indication is that our moving indicators are arranged or ordered with the 200 above the 50 simple moving average, the 50 simple moving average ordered above the 20 simple moving average, and the 20 simple moving average ordered above price, and also the order of those, right? So you're correct in saying that. Yep, the angle and also the fact that they are lagging indicators. The fact that they are lagging indicators is the fact that they're confirming what price movement has done. Okay, so let's go back to Jeremiah L's comment where he said $9 that could potentially be the new support level. Right. So you're correct, Jeremiah. So if we're going to go as our premise, that $9 will be our support level, as it's a natural level of support. It's almost a natural stop loss, right? The aim of trading, or the idea of trading, is to create a setup or an environment where price can freely move in the direction that you want it to move, or that you're betting on it moving, and then you want it to have as much hindrance to go against the direction that you want it to go, right? So you want clear, free air in the direction that you want it to go, and then you want it to be, as much resistance in the opposite direction, in the direction that we don't want it to go, right? So if we zoom bigger on our scale here, again, remember the green line is our current price, or where we're entering. The gold line would be our area to receive profit, and we're going to have to put a stop loss in order to stop us from moving out of the trade. So ideally, a natural place to put a stop loss would be here, where Jeremiah L has correctly identified that below the $9 level is as he said, a potentially a new level of support, and which is a natural resistance to price going down. Maybe we would put our stop loss just below that in order to hopefully our natural level of support will stop us hitting our stop loss and stop us from getting taken out of the trade, right? Remember, if we're taken out of the trade, then the trade is written down as a loss. So if we have a level of support before our stop loss level, potentially price could bounce off of this level of support and turn around and then head back up into the direction that we actually want it to go into, right? So it's a nice natural level of resistance in between, right? So here we have our setup for our trade, or what our trade would be. Our trade would be entry at this green line, our profit level or our target at this gold line, and our stop loss at this red line. Let me move it a bit lower so it's a bit more, so you can understand there's a bit of a gap between the two of those, right? So this is our actual setup for our trade, right? Now, again, I'm not by any means indicating that this is a trade that you should take on AMC. You should buy here, take profit here. I'm just using AMC as an example of a setup to a trade. So just so that we're clear, I'm not telling you that I'm not indicating a trade for you to take. I'm just explaining the setup of a trade, right? The aim here is we're understanding the setups and the principles of the trade. So in our example, again, to reiterate, in our example, this is our entry price, which is $12.01. Our take profit, or our target price, will be $15.36, and our stop loss price is $9.61. So these aren't exact measurements, right? But let's say, for instance, so how do we measure risk in a trade, right? Let's just do this first. How do we measure risk in a trade? Well, the risk in our trade, in our instance, would be the distance from our entry price to our stop loss, right? Remember, the stop loss does exactly what it says in the tin. It stops us from losing money. So for every time the price goes down, when the price is going down, if we've opted to go long, or we've opted to buy in this trade, or we've opted to speculate that the price is going to go up and the price moves against us, or the price goes down, that means each time the price goes down, we will be losing money. So we'll be making a loss, right? So this is called a loss. when the price goes down and we're losing money, we want our stop loss to stop us losing money. This is why it's called a stop loss. So what we do, we put the stop loss at a price in which we want to stop losing money at. We want to tell this, the stop loss is telling the broker that we are losing money. When we lose a certain amount of money, we want to be taken out of the trade, right? So in our instance, you know, if we take away, let's do some maths. I'm going to bring up my calculator because I'm going to be lazy. So our current price is $12, and we said we're going to enter at $12.01. If we say we're going to exit the trade, or we want to be taken out of the trade at $9.61, that's a minus of $2.04. So that means our risk for this trade would be $2.04. So that would be our risk. So let's say, for instance, our risk would be $2.04. So that would be our risk. How do we calculate our reward ratio? So our reward ratio would be what would be the distance to our take profit, or our money that we're going to make, right? So in this example, it's $15.36. So let's say, for an example, that the distance from our entry price to our take profit line was double the price of our stop loss. So we can actually calculate that. So if we say our risk reward ratio was $2.04, if we times $2.40, sorry, by 2, we get $4.80. So $12.01 plus $4.80. Let me calculate that. Equals $16.81. All right, so $16.81 is 2 times our distance to our stop loss. So what did I say? It was $16.81, I said, right? So we go $16.81. $16.81. Okay, so we know that this line is the space between the entry and our take profit line is 2 times the size of our entry and our stop loss, right? So this is what you would call a 2-to-1 risk reward ratio set up for a trade, right? Let me get where am I? Let me write this for you guys so you could go text. All right, so this would be a 2-to-1. This is how it's written. 2-to-1 risk reward ratio trade, right? Why is it called 2-to-1, right? No, it will be the other way around. Let me go the other way. Let me edit this. It'd be written 1-to-2. So our risk reward ratio. So in this example, we're risking 1%, or we're risking, 1% of the trade in order to get 2 back. So let's say, for instance, in our example, we have let's say for example, let's keep it simple. This is $100 trade, right? Or we have $100 account. 1% of $100 is $1, right? So if we're going to risk 1% of our account on this, and our risk would be $1 here, the return on this would be a 2% return, or a 2 times return. So $1 would return us $2. If this our 1% risk was, or our risk on this was $100, this trade would then return $200 because it's 2 on this risk, right? So we've got $100 and then 2. So it's a 1-to-2 risk reward ratio. So this is how you calculate the risk reward ratio of your trading. So what you will find is a lot of traders, whenever they're giving you a trading strategy, they will tell you, oh, this is a 1-to-2 risk reward ratio. Some people do it the other way. Some people risk 2% and only profit 1%. There's various different ways of doing this, right? So again, in this trade, the most you could lose is, your 1% in this example, and the most you could make at your target price would be your 2%. So you could lose 100% of your profit, or you could gain 200%, right? So this is called a 1 to 2% risk reward ratio, right? So this is important for you to understand, because unless you know what the risk reward ratio was on a trade, unless you can calculate your own risk reward ratio, you then truly can't understand how much money is really being made and whether or not it's a good trading strategy or not, right? So as I said, be mindful of the risk reward ratio of any sort of trading setups and trades, right? The return you get on your risk reward ratio or your risk reward strategy is contingent on how much you input, right? If you have the greater your risk reward ratio, the greater your return on your investment will be, right? And again, as I said, most trading platforms will give you a 1 to 2 return, maybe a 1 to 3. Yeah. Like the most you will get maybe is 1 to 2, or maybe 1 to 3, right? But again, when you're doing this, your rewards are still capped. Although you're leveraging how much you're inputting, your rewards are still capped, right? It's capped to that 3 times amount. And why would somebody put in a target amount? Well, they'll put it in a target amount because there's a likelihood that the price might reverse and return. So you would want to what they would call bank the profit when they get to this level, right? When it gets to a certain, it hits your target price point, bank the money. What they say, cash out, or yeah, bank your money, right? This is what you would do. So when price hits that target point, you would receive that money, right? So this is the setup of a risk reward strategy or a risk reward ratio in trading. So whenever you're talking about making returns, you want to make sure your returns are made up of or based on a good risk reward ratio strategy. Remember, majority of risk reward ratio strategies are based on 1 to 2% risk reward ratio or 1 to 3 risk reward ratio. Okay, now here's the thing. If you got, how many of you guys would like to have learn how to have an unlimited risk reward ratio? So basically 1 to infinity, where you can make money without capping your returns from 100% return or 300. So let me say that again. How many would you like to learn how to have an infinite return possibility on your trade, rather than only 100% return, 200% return, or 300% return? Let me get a 1 in the chat if you would like to learn how to, if you would like to have an infinite return on your trade, or 2 if you would like to only have a capped return on your trade. Jeremiah L says 1. You would like to learn how to have an infinite return and not a capped return. Remember, most trading platforms or most trading strategies, to be honest, even 1 to 2, 1 to 3 is good. Some of them will just do a 1 for 1. You risk 1, you return 1, right? Some say you risk 1, you return 1. Mo says 1. Mo says to infinity and beyond. You're going to be buzzing and you're going to be light years ahead of your competition. Lucian also says. So how you do it, I'm going to be a bit cheeky here. You go to focusoninvesting.io. See, under the focusoninvesting.io, under our trading strategy, we can teach you how to imagine you can have a trading strategy that allows you to set up your trade and not have a target price. See, this is how you get an infinite, this is how you end up with an infinite return, right? If you have no target price, then you have unlimited potential to make money, right? Because you're not taken out of the trade at a certain given price, right? Now, let me give you an example of, let's go to Microsoft, MSFT, in terms of a trading strategy. This is Microsoft on the daily time frame. Let me refresh. Let me zoom out. So Microsoft grew. It's been bullish. Salute to Gold Glow New Wave. Thank you for being a part of our stream. And thank you for commenting. So if we look at the Microsoft has been growing bullish since we can say all the way back since 15th of December 2011. Maybe we want to say 13th of February 2013. However we want to say, we want to calculate it, we can say it's been growing since that time, right? Where is my, here, my arrow? So we can see that we've definitely been seeing bullish activity in the market. So imagine you had a trading strategy that told you to get, 1-to-1 risk reward ratio, or 1-to-2, or 1-to-3. So for, let's say for instance, in our example, let's go back to when we start showing our growth. Let's say for instance, around here, we're going to take from this the 16th of April. So let's say for instance, on the 16th, let's do this. Let's say 16th of April. So our entry price here, we're going to say we wanted to enter. Let me do that. So we're going to do green for our entry price, and let's say here was our take profit line. We're going to say like this gold color is our take profit line. And then we're going to say because we're going to say we had a low here, we're going to say that was our stop loss, right? And we can see, with the aid of our focus on investing indicators, we can also see naturally where our support and resistance lines are, right? So we're going to enforce this one here that's shown on the red, and we're going to make this our red. So again, to reiterate, and I'm going to get in my DeLorean and get Marty McFly and go back in time. So let's go back to around the 23rd of April or so. So this was the price we're doing rough numbers here just for the example. So we can say that here, the green line is our current price and our entry price, which would be $29.26 in this example. We're going to say that our take profit line is, or take profit price is at $35.90, and that our stop loss or our take us out of the trade, if it goes against us, would be if price goes down to $26.20, right? So if we look at time as we move forward in time, let me zoom in a bit closer, might be easier to see. If we move forward in time, we can see as time went on, we were actually correct. We got entered into our trade here on this 19th of April. Price is moving in our favor. It's in the direction that we wanted it to move. Yep, fantastic. We keep seeing green bars, green bar again. Again, we saw a red bar. Remember, let me take off our trend filter, our focus on investing trend filter, so you can see. So we can see, yep, we had a bearish day. Price was down for the day. Forward, price went up for the day. Price went up for the day. Price went up for the day again. Price went down for the day. Remember, in trading, price never moves in one straight direction. Always expect price to, do 2 steps forward, 1 step back, 2 steps backwards, 1 step forward, right? So it always ebbs and flows in different directions. So, don't be afraid, or don't start getting emotional when you see a red bar, red candlestick in a trade. We always expect to see, red bars in a bullish trade and green bars in a bearish trade, right? So again, we've seen red bars, but notice the overall trend. Again, the overall price movement is also very bullish and moving forward, right? So again, we've gone down, price has gone down again, few days have gone down. We haven't become emotional, we haven't overreacted. We expected this in our trade, right? Again, green bar, bull, green bar, green bar, green bar. Look, multiple days of green growth. Good spike up in green growth. Green bar again. Red bar, red, green, 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 green. Red bar, almost at our take profit price. This is what price tends to do. When we're getting close to our target price, it tends to tease us and pull back. And, if you're emotional, you'll start panicking. But, if you understand trading, you'd expect this. Move back to green bar. We think we're out of the trade. We're back up again near our take profit line again. Back again, red bar. See this, the patience you need in trading. You don't get emotional. Green bar. Going for a while. So prices again moves closer to our entry. And then it's not until here we see on the 15th of July, we take our profit. So if we'd have had our 2-to-1 setup, we would have risked 1 and received double our money back that we invested in this trade. We would have risked 2-to-1. Happy days. Everybody goes home. Thank you very much and good night, right? That's what most people would have done, right? But here's the catch, right? If you have a limited risk reward ratio on your strategy, right? Quit playing games with my heart, as Jeremiah says. Yeah, that's how trading does it. It does play with your emotions, Smokey, as it was said. So if we'd done our risk reward, most people would be happy at just doubling their money, right? Most people would have been happy. They would have gone home and said, yeah, but we here at Focus on Investing, in the Focus on Investing Academy, we're not happy with doubling our money, right? We want infinity. If we want to understand why we don't have a 2-to-1 risk reward ratio, this will explain to you why, and this will show you why we don't do this and why we don't cap our profits. If you want to know, why we don't cap our profits or why we don't do a 2-to-1 risk reward ratio, let me hear you put infinity in the chat. Or put infinity and beyond. We had infinity before. Let me see you say infinity and beyond in the chat. If you want to understand how the setup and of having infinite reward return on your trades. You know why we do that? Let me see you put infinity and beyond in the chat. Remember, we here at Focus on Investing. We want to maximize our investment, right? We want to maximize how much money we put in and we got our return. We're not happy with just a doubling of our money and a doubling of our returns. We want to get infinity. All right, there we go. Chat is rocking with me. Jeremiah L put up the infinity symbol. Mo said to infinity and beyond. Luciana said infinity and beyond with the rocket symbol to the moon. You want to go to the moon, right? So this is why we don't do a 2-to-1 risk reward ratio. You know, most people would have been happy to be stopped out of this trade right here. But look what happened if we continue to play Microsoft, right? Those who would have cashed out already would have missed out on the potential of a lot more. Shout out to Gold Glow, Gold New Way also said infinity and below. Look what happened while everybody else was out of their trade and cash. Look at the money that we continue to bank while we was in Focus on Investing. If we hit the play button, look what price continued to do. Let me speed up. Price went down, right? Now some people would have panicked, but look, remember for each in our example, for each cent that price moves above the gold line, this is additional profit that we would have made, right? Look how much each time this price moves up, we're making more and more money. Let me bring it back on the screen. So everybody else would have been stopped out at this price. So they would have had a 2-to-1. So each time this price goes up, we are increasing the ratio of our money. We are multiplying, more fold on top of our money, right? So this is why we don't do like a capped amount of returns on our money. We keep moving up. Jeremiah S says, yo. Right. This is money that us here at Focus on Investing are making while everybody else is out of the trade. Everybody else got stopped out a long time ago. We're here still making money as profit keeps rising up. Now, remember, we're not increasing our risk for the money that we're getting, right? So we're not saying more money or more return for more risk. We're saying the same amount of risk. And even there's a way we can do our setup where we can have no risk, but still increase our return. Look, the price is still going up. Remember, the people with other trading strategies who are not part of Focus on Investing were out of this trade. When let me go back and look at the price. What date were they? They were out at $35 when price was all the way back at hit $35 back in our example was around January 2014, and we're here all the way up to, in our example, 4 years later, 5 years later now, and price is still going on. And this is only 2019, right? And they've crashed out at 20 something dollars. What was it? $25 we said, $35. Prices continue to go to 100 and something dollars, right? So all of this is money that we would have been making, right? Wow, look how many times that ratio is. What is that? 10 times? I can't even calculate that. How many times did you say, and then at this point here, when we had, so all the way up to 2020, when price dipped back down, we would have had a setup to cap our losses, right? So prices continue to raise up for how many years? Was that 6 years later? We said 2014. So what, 7, 8 years? 8 years of price growth. Price continue to grow. Yeah, we're at 270 in our example. What date are we at now? September 2021. So We're going to see where was the height, and then we're going to get a dip soon. So let's stop it here, right? So let's say our height was at 330, let's say 333 is a round number dollars, right? So imagine us making money, like we made the money all the way up to $333 when some people capped out at $35. So let's just say we went up to $335 and they was at $33 and we was at $300, $333. So that's what, 10 times? That's just 10 times in talking about profit. We're not even talking about risk reward ratio, right? So this is how we get unlimited risk reward ratio, by having uncapped profits, right? But again, you have to have a proper setup in order to get uncapped profits, in order to structure your trade in a way that you can do it, but also only have 1% risk, or cap your risk and not end up with 90% of your investment fund gone, like most people have done over with their cryptocurrencies. You have to have a correct setup. And in order to have a correct setup, you have to go to focusoninvesting.io, where we give you our full investment syllabus, and that teaches you exactly how to set up your trade, what prices to enter into, and exactly how to set up your trade, so you can have unlimited, infinity and beyond potential for your returns, but also limit your risk. You can actually have zero risk. There's actually a way of having no risk and infinite returns, right? So Jeremiah L says, sign me up. Yeah, just to kind of respond to your question before, you said, when is the university going to get built? It's already there. Focusoninvesting.io is where it is at. We've got our whole investment syllabus that breaks down to exactly how you set up a trade to get infinite returns with only with no risk. Actually, we can set it up to where you get no risk. So if you want to know how to get your infinite returns and infinite risk, you go to focusoninvesting.io. The URL is on the screen. All right, so we've gone well over time. Is there any questions on anything we've covered just now? Remember, if you haven't done so already, please hit the like button. If you haven't done already, hit the subscribe button. If you would like to support the stream, if you found this information, informative, if you've learned something, if you've learned how to, calculate the risk and reward for your calculate your risk and reward on your trades, and also you found it informative and on a strategy on how to now aim towards infinite returns. If you've done so and you found that informative and you would like to support the stream, again, you can hit the Cash App. The Cash App is on the screen. Let me remove this comment. Where are we? There you go. On the screen, you can see our Cash App is # focus on investing. And also you can see the URL for our academy or our university is focusoninvesting.io. Again, so this again put the call out. Are there any questions based on anything that we've just covered in terms of risk reward or the calculation of a trade? If everybody's with me, let me get a 1 in the chat. If everybody's up to speed, everybody understands. If it's been clear in what we've taught, let me get a 1 in the chat to see if you understood. Again, if you didn't understand it, let me know and I can cover anything that you need covering. All right. Jeremiah L says 1. Jeremiah L is rocking with me. Go New Wave is also rocking with me. Well, all right. Luciana says 1. Thank you. You're welcome, Luciana. And then also Black Sanzoa. Yeah, Black Sanzoa. Also, I want to make sure I read your name, sir. Is there. All right. Well, I appreciate you guys for joining me. Mo says one great class. Well, I thank you. Thank you for your compliment. I just hope you guys are learning, right? This is the aim for Focus on Investing, right? It's for me to make you guys experts. Remember the Dunning-Kruger scale. I want you to get past the point of, where you have false confidence and you get real, true confidence simply because, you have true knowledge of trading. None of this false confidence or make believe or pretending, um, you know, about how to to learn these stocks and this investment strategy. We want to create experts here. We want to have people get in the truth, and when people are showing you, you're making false statements or misleading statements to you, you have the knowledge and understanding and be able to break down their whole trading strategy and be able to identify if their trading strategy is good or not, and be able to identify if this is a good trading strategy or if it's a not trading strategy, right? So us here at the Focus on Investing community, we're becoming expert traders, and we're not becoming, traders with false confidence within these markets. All right. So again, a pleasure, and I appreciate you guys joining me. Again, once again, if you want to get access to the Focus on Investing Trading Academy, where you can get access to our full investment syllabus, where we break down all the steps of how to set up your trade, exactly what prices to enter into, where to place your entry price, where to place, your take profit, where to place your stop loss, how to set up your risk reward ratio, also what type of stocks to invest in. We also give you the stocks, like if you want to know, get stock lists of the ones to invest in, give you the actual stocks that you need, also give you access to all of our custom coded indicators. Then that's focused on investing.io. Again, if you want to support the stream, it's British pound side and focus on investing for the Cash App. All right, ladies and gentlemen, I hope you guys have a great week ahead of you. And again, don't forget to join us again next week for our next live stream, which will be 3 p.m. Eastern time, 12 p.m. Pacific, or 8 p.m. UK time. All right, everybody take care and have a good weekend. Peace.